Despite the fact that investment banks are some of the most important actors in the world of finance, the ways in which they generate money are frequently intricate and numerous. With the help of this video, we will provide you with a comprehensive overview of the business models utilized by investment banks by breaking down the key methods by which they generate revenue. Number 1. Advisory services and fees. The consulting services that investment banks provide are one of the primary sources of revenue for these institutions. M&A, which stands for mergers and acquisitions, is frequently associated with these services. For the purpose of providing strategic guidance, investment banks are brought in whenever two companies are contemplating a merger, or when one company intends to buy another. Investment banks are responsible for doing exhaustive due diligence, which includes carrying out an analysis of the financial health of the companies involved, evaluating the synergies that would result from the merger, and providing advice on the suitable price and terms. Considerable advisory fees are charged by investment banks for the provision of these services. It is possible for these costs to be a fixed number. However, it is more common for them to be computed as a percentage of the overall value of the deal, typically falling anywhere between 1% and 3%. Number 2. Underwriting and issuance. Providing underwriting services for securities is yet another significant source of revenue. New securities, such as stocks or bonds, are issued by corporations or governments in order to raise capital when they are in need of funding. Within the context of this process, investment banks serve as mediators. During the underwriting process, the investment bank will first purchase the securities from the issuer at a reduced price, and then they will sell them to the general public or to institutional investors at a higher price. The underwriting spread is a significant source of profit, and it is defined as the difference between the price at which the insurance was purchased and the price at which it was sold. Furthermore, the investment bank takes on the risk of selling the securities at the agreed-upon price, and as a result, it receives a fee for taking on this risk responsibilities. Number 3. Trading and market making. Additionally, investment banks partake in a significant amount of trading activity. In addition to buying and selling derivatives, they also purchase and sell financial items such as stocks, bonds, commodities, and currencies. Trading can be broken down into two primary categories: market making and proprietary trading. When a bank engages in proprietary trading, it trades its own money in order to profit from fluctuations in the market. In contrast, market making is when a bank provides liquidity to the market by being ready to buy or sell assets at any moment. This provides the market with the ability to make decisions. As a result of the difference in price between the price at which they buy and sell the assets, they are able to earn the bid-ask spread. Number 4. Asset management and investment services. Many investment banks have significant asset management departments in their organizations. These divisions are responsible for managing the investment portfolios of clients, which may include individuals, corporations, and numerous other types of institutions. Asset management is the process of putting together and managing investment portfolios consisting of stocks, bonds, real estate, and other assets in order to fulfill the customer's desired investment outcomes. The fees that investment banks charge for these services are often a percentage of the assets under management, AUM, which is the acronym for assets under management. The size and complexity of the portfolio can determine the range of these costs, which can be anywhere from 0.5% to 2% per year. Number 5. Prime brokerage services. The prime brokerage services that investment banks provide to hedge funds and other institutional clients are also widely available. The clearing and settlement of trades, the provision of leverage, and the provision of custody services for assets are all included in these services. The ability to trade in a more efficient manner and with greater flexibility is made possible by prime brokerage, which is an essential component for hedge funds. The costs that investment banks charge for these services can be determined by a number of factors, including the volume of trades, the amount of leverage that is offered, or a combination of these factors. Number 6. Structured finance and securitization. It is common for investment banks to engage in structured finance, which entails the development of intricate financial products that are adapted to meet the requirements of their customers precisely. One method that falls under this category is known as securitization, which involves the consolidation of different kinds of debt, such as mortgages, auto loans, or credit card debt, and the subsequent sale of these bundled securities to investors. Additionally, The bank makes a profit on the sale of the securities in addition to the fees it receives for structuring these products. The complexity of these items, as well as the ability to customize them, typically results in greater prices. Number 7. Research and sales. Another significant source of revenue is the combination of research and sales. Teams of analysts are employed by investment banks to do in-depth research on a variety of markets and particular securities. Institutional investors, such as pension funds, hedge funds, and mutual funds, can benefit greatly from this research. This research is either sold by the banks to their customers or offered to them as a component of a more comprehensive service package. In addition, sales teams are responsible for presenting clients with investment opportunities and carrying out trades on their behalf. In exchange for their services, sales teams receive commissions and fees. Number 8. Financing and lending. Additionally, investment banks offer services in the areas of finance and lending. They make loans available to enterprises and governments for a variety of reasons, including corporate expansion, acquisitions, and the fulfillment of operating requirements. It is possible to syndicate these loans, which means that the investment bank works along with other banks to supply the necessary capital, so sharing the risk. Interest is earned by the bank on these loans, and the bank also receives fees for arranging the funding. Investment banks earn revenue from a variety of sources, including but not limited to advising fees, underwriting spreads, trading profits, asset management fees, prime brokerage fees, structured finance fees, research and sales commissions, and interest on financing activities. They are able to negotiate the complexities and volatility of the financial markets because of their capacity to diversify among these several streams, which not only increases their profitability but also enables them to do so. With a better understanding of these dynamics, we are able to get a better sense of the significant role that investment banks play in the economy of the entire world.